Yo, what is going on, guys? Let me know if you can hear me. What's going on, guys? Good morning. Good morning. Good afternoon if you guys are on the East Coast or abroad. Just waiting on Papa J. Powell himself. Obviously, today is a big day. It is the FOMC meeting. Actually, you know what? Let me just tweet something real quick. So, the decision should actually come out before Jay Powell talks. And usually between 2 and 2:30, we tend to see a drop in the market. I will actually share with you our analysis from our own academy here, but we actually put together what happens during. Actually, you know what? Can you guys see this? Let me check. Yeah. So we put together an analysis of what happens usually between 2 and 2:30 Eastern every single time that we've had an FOMC this year, or an FOMC tied to a rate hike. Between 2 and 2:30 we see a drop in the market, and then after that we tend to see a rally. Right now we are seeing a rally ahead of the market. We're green. Let me just pull up the Market Watch tab. So right now we are seeing a huge pump in the S&P 500, a huge pump in the Nasdaq, as well as the Dow. The VIX is also up 2.5%. We are live trading this in the Discord as well in our academy. So the real-time alerts will be sent out there. It's a little hard for me to manage the real-time alerts as well as try to give you guys a live update on what's going on. But the expectation here is that Jerome Powell is going to raise by 75 basis points, right? I don't think that there's any expectation otherwise. Now, before, like a few weeks before, we did kind of see the idea of a pivot for some reason float about. In my view, that is what led to this initial pump that we saw here, or at least the continuation of this pump that we saw here, right? Because there were talks of a pivot. That, from my standpoint, was misdirection, a little bit of manipulation, and maybe some misguidedness as well as to whether the Fed can actually pivot here. It's way too early to pivot. We haven't seen inflation that's less than 8% year over year. We haven't seen a job market that is cooling off. The job market is heating up. We actually saw numbers from the private sector today showing that there are even more openings in the private sector than was projected. So there are parts of the economy right now that just don't support a Fed pivot. However, what we want to hear from Jay Powell is not what's going to happen today. I think that if you look at the Market Watch tool, let me pull that up. One second. If you look at the CME Watch tool, you'll see that, for today, it's a 95% chance that we get a 75 basis point rate hike, and only a 5% chance that we get a 50 basis point rate hike. So I think pretty much the market has already priced this in. If he comes out and does 100 basis points, or does, a 50 basis point rate hike, the 100 basis points will, I think, tank the market. The 50 basis points will obviously make the market rally, and the 75 basis points to me is priced in. So I do expect to see, a rally in the coming days. You guys know my targets. If you've been watching the TA Tuesday, TA Thursday announcements, you know that my targets for the S&P 500, if we do continue a melt up, is right around the 400 stage on the SPY, right around that 400 psychological level, which also coincides with this resistance level, and as well as there is a golden pocket here that I don't have drawn out. But let's see if there are any updates here. Again, the decision usually comes out before Jerome Powell starts speaking. Jerome Powell is going to start speaking in about 25 minutes. The decision will come out before then. And as I said, it's going to be 75 basis points. What the market is really going to be trying to dissect is what Jerome Powell says about December and beyond. We want to know is there a terminal rate, right? Is there a rate? What is the exact terminal rate? The rate at which the Fed is going to stop its rate hikes, and what is expected for December and beyond? Are we going to get these jumbo 75 basis points or above rate hikes? Is December for sure going to be less than 75 basis points? And what is the terminal rate for 2023? Right now, about 5% is what is priced in, because that was what was on the last Fed dot plot. 12 members out of the 18 or 19, I can't remember exactly how many there are. I think it's 19. 12 of the 19 Fed members are projecting a 5% terminal rate. So if he comes out and either confirms that or gives us a strict direction as to what the terminal rate will be for 2023, then I think things in the bond market will actually cool off. You'll start to see bond investors pour in. And I think that that is impetus for the stock market to continue this melt up here. But I don't think that the stock market is going to rally. Like, I don't think this is the absolute bottom, because the Fed is not done hiking. The Fed has to be done. The Fed actually has to be done hiking for us to find a bear market bottom. So I am personally not in the doom and gloom camp where I think this is like 2008. This is the most telegraphed recession that we've had in history. And I think it's already somewhat priced in that companies are going to see a slowdown in earnings. We already started seeing that with this last round of earnings. So from my standpoint, I'm not projecting the doom and gloom scenario where we see another 30-40% retracement from here, right? I just think that there's too much that is telegraphed. And especially if Jerome Powell comes out today and gives us a little bit more guidance as to what is to come in the future. So let's see if you guys, let me go to the chat and see what you guys are saying. All right, so he raised 75 basis points. Thank you guys in the chat for informing me of that. Let me check on CNBC. There it goes. So if let's listen to Morgan Brennan real quick, and then we'll get to Jerome Powell.
About data dependency and the fact that now you're starting to see the Fed look at this and approach this maybe in a slightly different way than we've seen it in the past, at least in terms of this statement. What does it mean? What do you think it tees us up for with that press conference in just less than 25 minutes?
It's interesting, Morgan. I think they brought up two important points that we really haven't addressed or seen addressed from the Fed in the past. The first is the cumulative part, which, if you acknowledge, they started near the zero bound earlier this year. We're now at 4% on the Fed funds rate, or close to 4%. So they've already tightened this year cumulatively close to 400 basis points. In a given year, that is pretty unprecedented. And the second part of the statement that I think, again, perhaps a nod to the bulls, or at least those that are rooting for a slower pace of rate hikes, they're acknowledging the lag impact. In reality, or the Fed funds rate, there is about a 2 to 4 quarter lag from when the Fed tightens to when we see it hit the real economy. Now, some parts of the market and economy are very interest rate sensitive, and we are seeing housing, for example, perhaps the most interest rate sensitive part of the market, already showing signs of softening, weakening, perhaps even rolling over. Rental prices, which, as we all know, shelter and rent components of CPI have been sticky, but the underlying fundamentals are telling us a different story. So it is interesting to hear, certainly, the Fed talk about in its statement that it is acknowledging that it's tightened quite a bit already, that there is a lag impact. Perhaps the next part that we may hear from Jerome Powell is they want to wait, see, and assess what that lag impact looks like. Do we see a softer labor economy? Do we see wage gains start to moderate a little bit? And do we see inflation rolling over in a more meaningful way? I think that's probably, even whether they acknowledge it or not, that's probably what they want to wait and see before they start or continue to move at this aggressive pace. So I think it's a good sign that they are thinking about things in a more holistic way. And certainly they're thinking about moving perhaps somewhat more moderately.
Jim, I want to get your reaction to this. It sort of strikes right at the question that everybody's been asking ahead of this decision, which is under what conditions would a step down to 50 basis points be appropriate? It's worth noting that the September dot plots, they actually indicated a 75 basis point hike for this meeting today and a step down to 50. And actually, you've seen that in the last two meetings. So how much has actually really changed here, potentially?
So I think a lot has changed.
Okay.
I actually think this is pretty huge. One of the things that the Fed said is that they want to get to levels that are sufficiently above neutral. What they're communicating right now, and I think this is the big news here, is that they want to get to a point where they just stop hiking interest rates. In other words, there are many forecasters out there that would have Fed funds forecasts going up to 5, 5.5, 6, and beyond in order to get inflation down. What the Fed just told us is that they're willing to get to a level that's sufficiently above neutral and keep rates there, and then wait for inflation to start to come down. So what that really signals today to me is that this is the start of the end game, meaning that, yes, the next move in December might be 50 basis points, and we might get another 50 and then a 25, and maybe they end at 5% terminal Fed funds rate. But then they stop at that level for a period of time, and they wait for inflation to come down, because sufficiently above neutral is the key. How much of a policy rate is considered to be sufficiently above neutral? Is it a 5% policy rate? The neutral Fed funds rate is 2.5%. So at 5%, you're 250 basis points above neutral. That might be sufficient. And from a cost benefit perspective, it doesn't do as much damage to the asset markets and to the broader economy by just in mortgage market, housing, and things like that, by just hiking rates and hiking rates and hiking rates in order to achieve your inflation goal. What they want to do is let these high rates marinate. As Mona was saying, these long and variable lags are going to come into effect, and that the necessity to continue to hike rates is not necessarily there once they get to their terminal, which I think is 5%. And I think that's the message that the market's seeing right now, and it's one of the reasons why it's bullish. I'd be bullish on this too.
David, do you see it as Jim does? Do you see it as the market does? Is this the first move of the Fed to prepare the public and the markets for the moment? I'm thinking in terms of a big 18-wheeler, the air brakes are releasing some of the air.
Yes, and I think this is very significant because they've gone from data dependence to forecast dependence, which of course is what they should have done all along. And the reason this is so significant is that if you look at leading indicators of inflation, things like the global vendor delivery index, it's almost back to normal levels. There are no ships lined up outside the port of Los Angeles anymore. We've seen gasoline prices come down. We've seen used.
So 75 basis points. Now they're just pontificating on what Jerome Powell might say. The pundits are saying that this is bullish because there seems to be language in there saying that the Fed is actually hinting at possible slowing of the tightening policy. Let's go ahead and read this here. Let's see. The Fed is widely expected to announce. Oh, this is an old article. It's expected to announce a 75 basis point rate hike increase, blah, blah, blah. Investors are also looking for a signal that the central bank is prepared to slow the pace of its rate hiking plan in December. Comments from the Fed Chair Jerome Powell play a key role. Yeah, no shit. Okay, so it just seems, honestly, that this right now is all speculation. Like, we know that the Fed is going to do 75 basis points because they actually just announced that to the media. They released it, but we don't know what Jerome Powell is going to say. Right now, if we take a look at the markets, you could see that. Let's look at what the stock indices are doing. Wow, I actually don't like the way that CNBC showcases what the indices are doing. Let's go to Market Watch. So the S&P 500 is up around 0.6, NASDAQ 0.3, Dow 0.9. We still have not yet heard from Jerome Powell. This is priced in. I'm seeing some things in the chat where some of you guys are bullish, some of you guys are bearish. So let's talk about that. Let me answer some of your questions before Papa J. Powell steps up to the mic in about 15 minutes here. Let's hear what you guys have to say. Because I'm seeing a lot of actually interesting commentary, okay? Zia says, crash incoming. I think a crash coming, says Random Ghost. Have some call credit spreads and put credit spreads. Let's see what happens. What the hell? So you're just playing both sides? Call credit spreads and put credit spreads. If you have them for the same expiration, that's called an iron condor, because an iron condor is made up of a credit call spread on the high end of the range and a credit put spread on the low end of the range. And you just want the price to be in between. So Abraham, I don't know if you realize that what you have is an iron condor and what you want to play is an iron condor, but that's a pretty ballsy move on a day where we tend to see big moves because depending on where your strikes are, you will likely get taken out on one of those sides for a max loss. So I don't know if you realize that or what your strikes are, but what you essentially have is an iron condor. Chris Higgins, good afternoon. Guillerme Alencar, hey there, Z. What's going on? Francisco Lopez, what's going on? Gunmetal 75, there we go. What's up, Gunmetal? Regine, what's going on? Good to see you. Good to hear from you. Nick, hi from Vancouver. What's going on? I bet you it's raining there. All right. So let's see if you guys have any questions. Fed will take cumulative tightening lags into account. Yes, Richard Soren, that is part of what they released, that they're acknowledging that Fed rate hikes have a lagging tendency. Now, why that is bullish is because that tells us that they're not just going to turn up the dials and overcorrect blindly, that they realize that 475 basis point rate hikes in a row, it's really 5 because they did a 25, a 50, 375s, and now a 475. So it's really 575 basis point rate hikes in a row. The fastest pace that we've ever seen rate hikes. And this is the highest in terms of a Fed funds rate since the 80s. So the reason that Jerome Powell saying, or the Fed saying that they're going to take lags into account is because they realize that this is a lagging mechanism, meaning they can raise as much as they want. Whether those actually hit the economy in the intended way, that's not up to them. It takes time for these things to trickle down. The economy is humongous, especially the U.S. economy, right? So it takes time for these things to trickle down into the economy. And that means what that means, or at least what we can infer from that, is that the Fed is now going to do somewhat of a slowdown at some point to see the lagging effects of these rate hikes. And we could see the market actually dropping a bit here. We're down to 0.2% on the S&P, 0.08 on NASDAQ, 0.61 on the on the Dow Jones. Now, what's interesting is this is not uncommon. We've done this research here in the Academy. By the way, if you want access to the Academy, link is in the description below. We just opened up spots for November, so click if you want to apply. But between 2 and 230, every single time on both the S&P and the NASDAQ, we've seen a decline, and then from 230 on, there's always been a rally. Now, the last one, the rally was very short-lived. We saw an immediate pop on the S&P. It was about a 2% pop at 230, but then the day ended up minus 3% because that was the most hawkish that we've heard Jerome Powell sound all year. So just keep that in mind, that even if you see a pop at 230, it doesn't mean that pop is going to last. It really depends on what Jerome Powell says. But between 2 and 230, we tend to see a slowdown, which we are seeing now until Jay Powell gets on the mic. So, let's see what happens here. And I'm sure that we are actually getting some day trades here. All right, not yet. So I'm just monitoring to see if we are sending out day trade alerts here. I will look back at 2:30 p.m. Eastern time. But for now, let me take your questions. So is 75 good or not? I mean, guys, you have to stop looking at this stuff as binary. It's not good or bad. 75 is expected. So that means that the market is pricing that in. But the market does not know what Jerome Powell is going to say when he opens up his mouth. So, yeah, it's expected. Everyone and their mom knew, looking at this here, it was a 95% chance that it would happen. But that doesn't mean that we know what Jerome Powell is going to say. If he comes out and says opposite of what the pundits just said. So the pundits just said, that they recognize that these are lagging indicators and that, we're going to have to pause and assess at some point that these rate hikes are aggressive, et cetera, et cetera. meaning that the Fed is actually looking to pause at some point in the near future, or at least slow down in the near future. If Jerome Powell comes out and reiterates that, I think that the market ends up green for the day. If he comes out and says something opposite, like it doesn't matter what happens, we're going to be raising rates at the expense of, the job market, at the expense of the economy, at the expense of a recession, then I think the market is going to drop. So it's not whether it's good or bad. The market is really manipulating this opportunity. John, the market is trying to take advantage of the volatility. It's not just, manipulators coming in and trying to manipulate. They're taking advantage of the volatility. That's exactly what's happening here. So yeah, there is obviously there are big orders coming in, but there's also a lot of retail trying to take advantage of the volatility. So it's not like someone's just in here pulling strings and the price is moving exactly as they want. They're also reacting to what is going on with the price action. So yeah, I could talk about manipulation and the tactics used in manipulation, liquidity grabs, how the market, how the institutions and bots really end up finding where people's stop limits are. We could talk about this after Jerome Powell is done talking, because that is an interesting conversation. To everyone saying traveling traders late to get the headline out, he has literally been saying for days and weeks that it will definitely be 75. Yeah, thank you, Michelle. Thank you for that comment. People with self-esteem issues just want to try and take a shot at Z. What's going on, Joe? I didn't read anybody taking a shot at me. Obviously the chat has been going crazy, so there might have been. But no, I appreciate people alerting me to the fact that the news was out as I was talking. So I appreciate the heads up. Is this live? No. You were dreaming. Kyle P. Yes. Roman, appreciate you, man. Roman is always donating to St. Jude's. I appreciate you. As you guys know, I make it a point that each and every live stream is a fundraiser to St. Jude's. So thanks to everybody who donates every live stream, no matter the amount. I really appreciate you. I'd much rather you guys use that button as opposed to the super chat button, and send the money there instead of to me. I appreciate anybody who donates any amount of money, even if it's 50 cents or $50. So thank you guys. And if you guys ever join other people's live streams, try to encourage them to do the same. Try to encourage them to do the same, because anyone can add fundraisers to their live stream. So Matthew Chesser, I'm short right now. Matthew, I would be very careful. I would take, make sure you are taking, I would say, capped trades, meaning risk defined trades. So if you buy puts, for instance, you can't lose more than the amount of money that you buy the puts for, right? So as opposed to going short on futures, this guy isn't saying anything new. I don't know if you're talking about me, Bryce Richards, but quit hating if you are. And you're free to leave, Bryce. Nobody's making you stay. If you're talking about one of the pundits that I was showcasing on CNBC or something, fine. But if you're talking about me, you're free to leave, bro. Catherine Wolfert, Z called it. Inflation is too high and unemployment is so low. Yeah, exactly. Who's in plays right now? If you guys are part of the academy, check for the plays. I'm sure some will come out right at 2:30. Should I get my stock advice from Jim Cramer? Yeah, except for just do the exact opposite and you'll be fine. I'm only in shorts. Again, Jaegerist. Hopefully you guys are taking capped trades and not uncapped trades, because whether you're taking a long or a short, if it's not a capped trade, these things can turn against you, right? Pretty quick. So, RIP Takeoff. Yes, Chrome. What a fucking shame. Yeah, I mean, we could talk about that after Jerome Powell, but what a fucking shame, honestly. Shalita, what's up? Z for Louisiana. What's going on, Louisiana? He better continue to stay hawkish. Probably not. Why is TLT dropping? Zachary, I told you in my last video why TLT and why bonds would initially drop is because the rates are going to increase. Obviously, we increased by 75 basis points. So when yields go up, bonds go down. But after the announcement, if Jerome Powell actually gives us an expectation of what's to come in 2023 in terms of rate hikes, then you can expect bond yields to start dropping gradually, and that is when to actually start playing things like TLT. You don't buy TLT right before the Federal Reserve starts raising rates. Check out my last video on that. A vid on bot trading would be great. Not bot trading. There are no bots that you can buy that are going to work. There is no easy route, right? Everything in life has a risk reward based on effort. You're not just going to fire up a bot and start making money. Look, if somebody actually had a bot that worked that passively, where you could just turn it on and start making money, why would they sell it to you? They would be at a disadvantage if more people use the bot, right? Because then they would lose their edge. It just doesn't make sense. They're taking money from you if they're selling you a bot that somehow works passively, where you could just turn on the bot, go to work, come back from work at the end of the day, and you made money. Why would anybody fucking sell that to you? That just doesn't make sense. What I was talking about with bot trading would be how there are the different ways that institutional algorithms are set up to take out your stop losses, right? To Wayne Hilton says, thanks for everything. Appreciate you, bro. Nick, believe it or not, it's pretty much sunny pretty much all October. Oh, in Vancouver? Yeah, man. Your content is second to none. Appreciate you, DJ Heisen. Ciao, goat. What's up, Alex? What do you think the market goes from here on? I already spoke about this. It's a lot more nuanced than good or bad or up or down. TLT dropping because we are risk on for the moment. Yeah, I mean that, and the fact that they are going to raise rates. So why would TLT increase if bond yields are going up, right? Plus, yeah, exactly what you said as well. When the stock market competes with the bond market and the stock market looks more attractive, which right now in the immediate term, since the information is priced in, it looks more attractive. That means that yields are going to go up because less people are investing in bonds. This is a good place to start a position on blue chips. I don't know what you mean by good place, but I think you're a bit late if you're talking about an optimal trade. Because we were at support, and right now we're in the middle of the channel, and we are likely, going to be shooting for this resistance level here. So I think that, when we're sitting here at support for 4 weeks, that is the optimal time once we made a new low to get into longs. But if you are, just talking about dollar cost averaging, sure. Do you have positions right now? The only position, and I've made this known, the only position, if you're talking about stocks that I have, is XLE and XLU. And I did dollar cost average into the indices when we spent about 3 or 4 weeks here. And yeah, all that stuff was sent out in the academy. Tin, you're my trading idol. Appreciate you. Thoughts on Amazon falling? I don't know. Thoughts and prayers? I don't know what kind of thoughts you're looking for. Anonymous, appreciate your donation to St. Jude's. All right, let me go back to Jay Powell, and I promise I will answer your guys' questions after. So, oh, you know what? He didn't start yet. Let me keep this up. And once he gets on the mic, I'll shut up and let him talk. S&P 500 back up 0.8. NASDAQ up 0.85. Dow Jones up 1%. Can you just start a hedge fund? I'm actually working on this. Bryce Richards. Yes, I was talking about the pundits. Oh, appreciate you, and apologies for jumping the gun, Bryce. Thanks to you have good education and patience in investing. Your group has made me a better trader. Appreciate you, Aditya. We try to provide the best group possible. Again, we open up spots for November. Click the link in the description and make an appointment because those spots will go up fast. You get access to the day trading course, the options course. We do a Zoom call, 2 Zoom calls every month with me where I answer all of your trading and charting questions. And you get to chat with thousands of traders and get access to all of the alerts. Investing Guru donated $5 Canadian. Appreciate you, Investing Guru. Thank you so much. John, Z and the team always help me know what to expect during these events. Profitable week as usual. Appreciate you, man. The analysts and Z's trade alerts are the best. Thank you. Do you trade TZA and TNA? No, I don't. I don't typically trade. Oh shit! Look who's stepping up to the mic. All right, guys, I gotta shut the fuck up and let this guy speak because you guys don't want to hear me.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Colby.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was and has been how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate. And we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time. And we put that into our post-meeting statement because that really does become the important question we think now is how far to go. And I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming. And it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Yo, this guy's going crazy right now.
Nick Timmeros, The Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher. I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, many different people who publish an assessment of underlying inflation.
Thank you.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that, so that's very concerning. I guess the other thing I would say is that the longer we have, we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to the lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up,
Man,
should we
he's
interpret
coming
the
out
addition to
with
the
the
statement to
guns
mean
today.
that
We'll
more
talk
weight
about this
is
in a
put
second.
into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and
respect for keeping it real.
A new summary of economic projections, which updates that, but I would expect us to continue to update it based on what we're seeing with incoming data.
This is not bullish for those that are asking.
Thanks, Chair Powell. Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of labor market, consumer demand, a lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? Housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back.
I'm gonna start commenting on a second.
They're not historically
just
high,
be
but they're
patient.
much higher than they've been, and you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
All right, guys. So I'm going to just be monitoring the questions here while I answer your questions and cover what was said so far. So apologies for keeping it running, but he was saying a lot of important stuff, and you're seeing the market tanking now. As I said earlier, this is not bullish. This does not sound bullish whatsoever. So for those of you that thought that he would come out and try to pump the market for political reasons, so far that is not the case. Now, whether the market recovers or not, who knows what happens on a single day. But if we're just looking at what he said, if we're just looking at the content of his speech, and I'll get to your guys' questions in a second because a lot of you guys are asking good questions. What he said is actually pretty bearish from a standpoint of the stock market, right? But it's actually what is needed from the standpoint of monetary policy. So he talked about the labor market being out of balance, how there's the supply or the demand is is really straining the supply right now. The job market is as hot as it's ever been, and that's one of the reasons why they have to continue. Obviously talked about how sticky inflation has been. And he was saying that ongoing raises are needed until they reach their target rate. He did not mention what that target rate was, which was one of the things that would have made this a more bullish speech. He didn't mention that at all. He mentioned that rates were lagging, meaning that the effect of the rates are not going to be known immediately. And automatically people thought that that was bullish, which is why you saw the market rally right before he talked, because the pundits just took that word or that term lagging and thought that it was going to be a bullish speech or a dovish speech. He did mention that they were lagging, but then right after that, he came out and said, there's a lot of ground to cover. We'll base it on data. And I don't think that we have over tightened at all. He says, I don't think we're anywhere near over tightening. So I think the pundits were hoping that he would come out and say, hey, we've tightened too much. We're scared of breaking things in the economy by tightening too quick. But we actually don't think we've over tightened at all. This is nothing, basically, what he's saying. And then he even said, when he got a question about the December meeting, he said, you know, we will assess in December, but I won't be surprised if, you know, the rate hikes are higher than we expected to be in December. So he's not really mincing any words here. And then he said, I don't want to make the mistake when they were asking about the risks of monetary policy here. He did not talk about the risks of over tightening at all. What he said was there's a risk that we loosen too early. That's all he said the risk entailed. So he's not talking about the risks of over tightening. He's not even saying that we've over tightened. As a matter of fact, it sounded like he thought what we're doing so far is not enough because the labor market is so hot and inflation, and he referenced PCE there, but inflation is still hot as well, and that it's too early to talk about anything called loosening or pausing. He even said, he didn't use the word funny, but he basically said that he thought it was peculiar that folks were talking about pausing or pivoting this early. So as hawkish of a speech as you can get so far from the man himself, Jerome Powell. And, you know, again, from a monetary policy standpoint, this is what you want to see. If you're trying to fight inflation, this is what you want to see. If all you care about is the stock market, this is not bullish at all, because this signals that there is more aggression to come in December and beyond with regards to rate hikes. So, you know, that's where we are at the moment. Let me get to your questions. The dollar is dropping. It should be bullish. Marianne, you're looking at one data point. The dollar dropping doesn't really mean anything for the market. You have to look at yields. You have to look at where the expectation of the Fed funds rate is, et cetera. The dollar dropping on its own doesn't mean that the stock market moons automatically. That's just one data point. You should start an actively managed Z ETF. Yeah, I will. I'm honestly looking at starting some sort of fund at some point, probably within the next couple of years, when I have time. And obviously, I want to do it properly and work with the proper channels in order to get it set up. But yeah, I am definitely. That is one thing that I'm definitely looking at. Do you still have TLT, guys? I think everyone bought TLT because of your last video. Go back and watch the last video. I didn't talk about buying TLT. I said that TLT, if the Fed comes out and gives us an indication of where we are going with the Fed funds rate, which then affects yields, if Jerome Powell comes out and gives us a clear direction of where we're going, then you will likely start to see bond investors come back into bonds. And I was specifically looking at the 10-year treasury, right? And I remember drawing this, was it on the weekly chart? I remember drawing this trend line here. No, actually, it was on the daily chart. But looking at the 10-year Treasury, saying that, you know, until we get bond investors pouring back into bonds, into Treasury yields. Was it on the 10-year? I actually can't. I'll have to go back to that video. But until we get, you know, bond investors pouring back into bonds here, to lower the yields, that is when TLT will rally. But based on what Jerome Powell said, he didn't give us a direction for the Fed funds rate, right? He didn't even give us a target. He didn't say that we're going to slow down in December or slow down in 2023. He didn't give us any of that. So that is what I was saying would allow TLT or help TLT to find a bottom, is if Jerome Powell gave us a direction and bond investors started pouring back into bonds. Because what happens when bond investors pour into bonds is that bonds and bond ETFs rise while yields go down, because there's an inverse relationship between bond prices and bond yields. This says nothing about buying TLT during a extremely risky and random binary event. So go back and watch the video and you'll see what I said. Junior, appreciate you for donating $20 to St. Jude's. Thank you so much. Will Lucid stock go up now? Probably not. Lucid is a very struggling car company in its early stages. You need it to be able to scale, and you need it to be able to sell. And right now, it can't do either of those things. So it just remains a speculative stock. Bots worked for online poker. Online poker is not trading. There's so many more people in trading and many more powerful people in trading. That's why people lose money. They think they can make easy money. Yeah, for sure. I meant algo trading, not bot. I'm not going to do a video on algo trading, but for sure, there are patterns that you can look at in trading every single day where you will see that people's stop losses are taken out constantly. And it's because institutions are placing their orders there. See, okay, if I'll just explain it really quick. But when you're taking a look at, you know, say that you're on the S&P futures, right? You have a resistance here. You're taught about support and resistance in a beginner's class, okay? You have your resistance here, and this is the area at which you are going to short, right? You're like, okay, once we get here, I'm going to short, and I'm going to place my stop limit above resistance. So you end up placing your stop limit somewhere here, right? And you see this all the time, and it's happening more and more recently. But you get these wicks that take out your stop limit, and then you get the move you want. Why is that? Well, if everybody is shorting here, right? Everyone and their mom is shorting here, and institutions obviously want to short there. Where are institutions going to get their liquidity? Because when you are shorting, you are selling the stock, you know, to open, and you need to find buyers to sell to short here, right? But institutions want to do the same thing. So who's going to sell institutions their stocks, or who's going to buy stocks from institutions to set up their short orders here? Well, if everyone's doing the same thing, institutions are like, well, we know that there are a bunch of stop limits up here. This is where we will grab liquidity. This is why this is called a liquidity pool or a liquidity grab, is because they know everyone's stop limits are here. And what is the opposite of a short is a long or a buy order. That is how you set a stop limit for your short. So that is where institutions will be getting their desired orders filled from in order to short. They come in here, they pump the price up, take all of your liquidity in the form of shorts, and then the price starts dropping, right? So that is why it always seems like your stop limits get taken out, is because that is exactly, they know that everyone's using the same rudimentary and beginner level TA. And that is where bots and institutions are looking for liquidity. They need that liquidity in order for their orders, their large orders, to fill, or else, if everyone's doing the same thing, they're not going to find any takers for their orders, right? What point would you be comfortable buying TLT? Jesus, guys. Again, TLT or bond funds were based on the expectation that Jerome Powell was going to give us a sense for where yields are going to be headed, right? Where the Fed funds rate is going to be headed, where yields are going to be headed. That would give bond buyers confidence to pour into bonds. When bond buyers pour into bonds, that is when funds like TLT go up. If we're expecting the Fed funds rate to just rise into oblivion, bond investors are not going to pour into bonds, and you will see those yields continue to rise. If those yields continue to rise, TLT actually drops. It does not go up. So right now, I don't see it as an optimal trade because Jerome Powell didn't give us what we wanted. I loved your last video. So good. Appreciate you, Righty. I try to do that in every video. Bots work on Forex and futures. Yeah, right. Space Abe. Sure they do. Sure they do. Marcela Ruiz, new to your channel. You are becoming my favorite. Appreciate you, Marcela. The best bot seller would be running a strategy against the bot. Exactly. Think about this. If you had a bot that just prints money, you would not give it to anybody. Like if I built a bot and I'm like, holy shit, I've come up on a gold mine. I get to run this thing, go to the gym, go play basketball, hang out with friends, go motorcycle riding all day, come back, and all of a sudden I look at my account and I'm up $2,000. Why would I ever sell that? Like, why? Why would you ever sell that? The minute that you give up that edge is the minute that you no longer can live this this lavish lifestyle. So anyone trying to sell you a bot is bullshit. Okay? Anyone trying to sell to you is bullshit. I'm not, discounting that there are some extremely genius level programmers who also happen to have been studying, millions and millions of days of price action or hundreds of thousands of days of price action and are able to then write a bot for themselves. I'm not discounting that. I'm saying that anyone that's selling you a bot, if they're selling it to you, it just makes no sense. There's no reason why they would be giving up their edge like that, right? Just like imagine that somebody knew how to beat the casino at a game. Why would they ever give up that strategy if they know that casinos are going to catch on to that and correct for it, right? Just like with card counting. When card counting became popular, what did Vegas do for all of those who play blackjack? They started implementing those, what they call shoes, which are these black boxes. You don't know how many decks are in there. You don't know how many cards are left in the deck. And then they shuffle those randomly to even make it harder for card counting. And that is now card counting, unless you're playing single deck, you happen to find a single deck blackjack table, which there aren't a lot of around, and certainly none that pay 65 for a blackjack. They've basically eliminated your edge. So why would anybody give up their edge? Dina Del Sol donated $20. Appreciate you, Dina, or Dinah. I apologize if I'm mispronouncing your name, but thank you so much. What up, Z? You're the GOAT. Appreciate you, Richard. All right, let's see. 10-year and 2-year are going down. Why? Are they? Let's see. What is the 10-year yield right now? The 10-year yield is actually up. And the 2-year yield is the one that is directly affected usually by the Fed funds rate, and that one is flat. So I don't see them down. My mom loves you, Z. Appreciate you, JM Garcia. Randall T, what the fuck, TLT? Why would you buy TLT for the FOMC meeting? That's all right, guys. You should look at the relationship between bond yields and bond prices. Buying TLT before a Fed funds meeting where they're expected to raise rates is not the way to go, unless you're expecting Jerome Powell to come out and, give an indication that, sorry guys, I just took a futures trade while I was talking to you. Unless you expect Jerome Powell to come out and say something bullish, then yeah, you could have taken a chance at it. But why would you just blindly expect TLT to come out, especially when he came out and gave zero indication of where we are going? Do you hold TSM in your long-term portfolio? Not at the moment. The only thing I bought is XLE and XLU very recently. Sorry, I'm just monitoring the price action here. All right, sorry. I'm going to apply to work for Z's hedge fund. Appreciate you, Joe. Yeah, we'll definitely be looking for takers here. I mean, for employees here. Sorry, I'm just in a future short at the moment. I took it when it hit my level. I'm about to close it out, but I want to see how low we can go. Let me see if I can show you what position I'm in. All right, I got the capital, but have not been able to profit. I guess I'm dumb. No, I mean, trading is hard, guys. Like, why would you expect trading to be easy? Trading is very hard. End of the day puts, you're paying a very high premium for that, Preetham, because the move has already been made. You could still make money, but you're paying a high premium for that. I'm just in a short right here. I took it. I'll explain this trade in a second, but it's up $500. I might just close it right here. All right, cool. Quick 340 while I was on the call with y'all. I'll explain that trade in a minute. It looks like we might have some more downside left, but I can't make this entertaining and try to trade at the same time. So I guess I'll settle for $400 for a quick trade at the moment. All right. Yeah, Ence Mitchell. Think of trading like any other thing that you want to be a professional at. And if you guys want me to show you, the trade, I'll go over it in a second. Just leave it in the chat, and also leave that thumbs up so that other people can find this. But trading, just like, so, okay. This is very interesting. There's somebody in the Discord community who is a surgeon, and he said that trading is harder than surgery, right? And it got me thinking, why do most day traders lose money? And most day traders lose money because what happens is the barrier to entry is very easy. Anybody can open an account and start clicking buttons, right? But you can't just show up at a hospital and say, I want to try surgery and see what it's like. You can't just, show up at a Laker game and be like, I want to play tonight and see how it's like to be a pro basketball player, right? Actually, at a Lakers game now, you might be able to. They'll probably take anybody at the moment, considering how bad they're doing. But trading is the same thing, right? Like, it takes years of practice to become profitable. It has such a low success rate because the barrier to entry is super low. Anyone can just open up a trading account, like literally anybody, but you can't just try something else professionally. So that is why trading has such a low success rate, because people think that it's as easy as opening up an account, and it's a lot harder than that. It took me 3 months of trading options, paper trading options, before I even put $1 in. Now I'm talking about, 12, 13 years ago. But it's extremely hard. It's not easy. So you're not an idiot if you're not successful from the first try. Ence Mitchell. Anonymous donated $5. Appreciate you. Thought about BJ's, like the restaurant? I don't know. I haven't been there in a long time. J Powell looking older. Yeah, for sure. For sure looking older. Exactly as Z said, 75 basis points. Yes, Jerome Powell could become Paul Volcker, not in his best dream. But yeah, certainly more bearish at the moment than he's ever been, right? More hawkish, I guess. Al donated $5 to St. Jude's. Appreciate you, Al. Thank you so much, brother. Thank you. Hi from Serbia. What's going on? Bullish as fuck is actually very bearish. Not sure why you'd say bullish. It's very, very bearish. I was hoping to hear a temporary pause. Yeah, he even scoffed at the idea of a temporary pause. He said, I'm confused as to why people are talking about this. All right. Let's see. 100 basis points next hike. Probably another 75. What's the H word? H word is higher. He used the word higher. This guy's dancing around these questions. Actually, he started off dancing and then went full-blown nuclear. All right, let's see. Ask him about the terminal rate. This is what I hate about the YouTube chat is you're scrolling and then it just jumps to the end. Al, can you offer a video or course on data points for trading daily, weekly, monthly? Not sure what you mean. Data points for trading. Apologies. Not exactly sure what you mean. Randall, go back and watch that video, bro. No, I didn't. Go back and watch that video. Yeah, David, exactly. Stay away from TLT. There's no telling when any pivot might occur. Exactly. TLT was the play if we got pivot talk or if we got an expectation, right? Is the bear rally over? I think we'll see a bump after elections like we normally do. But this was certainly bearish. This was certainly bearish for sure. This channel is much better than Jeremy from Financial Education. I never watched that channel, but appreciate you. Thank you. All right, told y'all green end of day. I don't see green. The S&P is down 1.13. NASDAQ is down 1.6. I'll watch again, but I believe you said you were up on TLT calls. Yeah, I was up on TLT calls. I didn't say I'm buying TLT for FOMC. I bought TLT when there was all the pivot talk before FOMC, right? That's when I was up on those TLT calls. I didn't say I'm buying TLT right before FOMC. That would just be crazy talk. Thoughts on getting a fifth monitor? I only have one, so do what you need to do. You are now talking to me. You are now like me talking to my spouse. One eye on her, the second on the chart. Yeah. Just scalped 500 while teaching 1,400 people live. Yeah, I did because I was looking at the. I'll show you my trade in a second. I'll show you my trade in a second because it was a very interesting trade, and I actually would have been up a few thousand at the moment, but I had to close it because I couldn't monitor and try to answer the questions in an interesting fashion. But I'll show you. Oscar, the restaurant, sure. What's up with Roblox? Not sure. Haven't looked at it in a while. Are you buying some Powerball tickets? No, I'm not. You know what's so funny about Powerball is I was talking to my girl about this yesterday, but it's crazy how you see people wait for the Powerball to reach $1 billion, and then they're like, okay, yeah, now I'm gonna buy a ticket, right? Like as if 500 million is not enough of a draw, as if 100 million is not enough of a draw. Like people scoff at the possibility of winning 100 million. They're like, no, I need this thing to be $1 billion. Then I'm gonna give up my $2, right? It's like you have the same chance to win as any other time. Actually, it's worse once it hits $1 billion because now the surge in tickets means that for sure there's going to be a split prize. So whereas when you were playing, if you play Powerball when it was 100 or 200 mil, you might have been able to keep that for yourself if you won. Now you're going to share $1 billion with 8 other motherfuckers, right? So it's not like you're going to keep the $1 billion for yourself. It's just so funny that people wait for it to get to $1 billion. They're like, yeah, now it's good enough. Now I'm going to buy a Powerball ticket, as opposed to just, buying, Powerball when it's 100 million or 200 million. But yeah, anyway, that is hilarious. That's me, $1 billion or more. Yeah, exactly, Tito. All right. Love the effort, man. Cheers from Finland. Yeah, I've had a food day playing the options today. Thanks, Z. Appreciate you, Lewis. Let me know what you took. Got your Lifetime Academy, bro. It has paid for itself in a month. Appreciate you, man. Thank you. Dem Hooks Travel. Thank you so much. Z, what's going on? What's up, Daniel Padilla? What's going on, man? Yeah, so I'll show you this trade that I took. If you guys want want to know this quick $500 trade that I took. 1 second. Let me just. All right. So the trade that I had taken on the chat or on live here, I was looking at a futures trade on ES, right? So this is where essentially Jerome Powell had, initially he was talking about lagging and talking, basically flip-flopping, and it sounded like he might have started to get bullish here. But then this, right around here is when he said, no, we're not even thinking of pausing. It's funny that anyone would think that we paused. And we don't even think that we over tightened. Then the market started tanking, right? So one thing you could have done if you were breakout trading is you could have shorted the market here, right? But I was talking to y'all. But you could have shorted the market here once we broke out of support. You could have either shorted on the futures trade, or you could have bought puts here, right? I didn't catch it, and I generally am doing less breakout trading now. What I generally wait for is a retest of an area where there's an imbalance, and you can judge an imbalance by a few different ways, right? I know that there's a popular method now popularized by a trader called Inner Circle Trader, where they identify imbalances by something called a fair value gap. I'm not going to explain exactly what that is here, but basically you end up having these imbalance gaps. You learn to draw them. They're a series of 3 candles. And so we created this fair value gap here, and we rallied back into it. So the thought is that after a large move down, the market will always go back to retest this imbalance. And then this is the optimal area in which you want to take the position down. So I shorted from here, and I ended up closing it right around here because I was trying to answer questions on the chat. But if I was more patient, you could have waited some more, at least in order to get to the previous low here, the previous area where there might be some liquidity. That position would have been up thousands of dollars. So whatever. It was a quick $500, and I'm okay with those gains. But yeah, that is essentially how I spotted the trade. And the reason that this is very optimal, let me see if I can maximize this real quick for you. The reason, and this is the 1 minute chart, but the reason that this is optimal is because you can literally set your stop limit right above this, right? So it comes back up to address this imbalance here. I took it short from here, right? And I can easily set my stop limit right above. And you also have VWAP here, which usually acts as interim resistance as well. So I can easily set my stop limit at VWAP or right above, or even just right above this fair value gap here. And then, if it doesn't hit, great, I will just ride the position down. That is why this type of trading is super lucrative, and there's a high risk to reward because you are taking high probability trades with a very tight stop after the imbalance is addressed. And I know that a number of traders talk about imbalances in different ways, and this is just one of the ways that you can identify imbalances, right? So yeah, that is why I took that trade. If you guys have more questions on it, let me know. We'll be happy to go back into that. Goblin Gaming, appreciate you for donating $20 to St. Jude's. Thank you so much. How do I upgrade to lifetime? Hit that link in the description. You see it right there, the first link in the description. And yeah, those spots will go up pretty fast because the first of the month was yesterday. So be sure to sign up. Any plans on traveling to Africa? I've actually been to Africa quite a few times. Yeah, it's a huge continent. I definitely have not visited enough spots in Africa and would love to. For sure, would love to. Dude, turn your night mode on YouTube. You turn it on. Like, why do you care about my own YouTube? You can turn it on for yourself. All right, cool. Any questions about the trades? or charting or whatever. S&P about to break through 3,800 support. Yeah, I mean, Jay Powell was as bearish as ever. So, yeah, I can easily see that. I can easily see that. JC, I'm going to strangle Z if he doesn't trade my money. All right. JC, how much do you weigh? Tell me right now. How much do you weigh? I need to know right now. Are we headed to 3,500? Okay, let me take a look at the SPY. In the meantime, JC, tell me how much you weigh. No, not even kidding. So what happened here with the SPY, obviously, you know, this was make it or break it day. And if Jay Powell came out and sounded bullish and told us, hey, September and December, we're going to slow. We actually think we've over tightened. We are at risk of over tightening. We're going to slow in December, and the terminal rate for 2023 is 5.5%, right? Then I think we would have seen a rally here. The fact that he came out and said, I don't even think we over tightened. There's no risk of that. The risk actually is loosening. I don't see any reason to pause or slow down. December might get another jumbo rate hike, and then we'll assess from there. All of that is super bearish, right? So we are now in the middle of this descending wedge. And it looks like we are headed back down to retest the support. As you guys know, depending on what happens with FOMC, depending on what happens with earnings, my target for the indices is the pre-COVID highs, right? So that would be around 340 on the S&P 500. On the actual S&P itself, we are looking at around 3,400. That is my eventual target. I'm not saying we'll get there now. We could just chop around, because remember, the elections are coming up November 8th. So we could just chop around for a long time, see a small rally during elections, whatnot. But yeah, I mean, it's for me, the target on the S&P eventually is 3,400. That is my target, right? But long term, I'm bullish, and I do think we have less downside than upside, right? So yeah, I'm gonna get to your questions in just a second. All right. JC said, I wish I weighed less. No, I'm asking you because if you said that you're gonna, if you said that you're gonna strangle me, I would like to know how much you weigh, because we can actually try this out. 215 gonna get handled. JCZ ain't no slouch. Yeah, I mean, I'm not 215, but I think someone who's 175 with skills can easily beat someone who's 215 with no skills. All right, hence the market selling off. Hawkish equals tanking. Yes, hawkish means more aggressive. Dovish means less aggressive. So, all right, bro, I want to ask something. Jerome Powell, hawkish or dovish? Hawkish. Hawkish. When's the last time you came to Alaska? I actually never been to Alaska. All right. Where we headed 3,500? Yeah, I think 3,400 on the S&P is for me a good long range target or mid range target. Dot plot, please. Did the Fed release their dot plot? Let's see. Okay, I think we got. Did we get? Wait, do we get a new dot plot today? I don't think we do. Because the dot plot is the summary of economic projections, right? And I don't think we get a new one for today. So for those of you asking what Bryce's question is, the dot plot shows you where the Fed is expecting the federal funds rate to be in the future, right? Like the terminal rate. And the last dot plot showed that most Fed members thought it was 5%. And I think it's going to be higher now. Simply because Jerome Powell gave zero expectations on where we were going. So I don't think, let me know if you guys know in the chat if a summary of economic projection, I should know this, but I don't think there's one for November, because we just had one in September, and I think we get 2 a year, right? Yeah, I don't think we have one this for November. All right, I should have stayed in that fucking short. God damn it. This would have been up like 4K per contract at the moment. See the sacrifices I make for y'all. See the sacrifices I make for y'all. And that was like the optimal short. We did not retrace since then. That was the optimal short. Remember, I was talking about how, you know, when you get in positions, you want to get in optimal positions after an imbalance is retested, right? And we just fucking free falled. We didn't see any retracements back up to where we can then short again. God damn it, I should have stayed in this. This would have been up like $4,000 a contract. No lie. Fuck. I mean, you know, profit is profit, but you know what? One of these days, would you guys be interested if I just did a live stream where I'm trading and not talking to y'all? Because a lot of times I get really caught up in trying to make this entertaining, instructive, trying to give you guys the best information possible. Like, would you guys be opposed to that? Because I'm always very wary of whether, or very conscious of whether I'm providing you guys with something entertaining and informative, right? So if I'm just sitting there like listening to music, it would have to be copyright free music. But if I was just sitting there listening to copyright free music and trading for like 5 hours, would you guys like that? I don't know. I don't know how many people would join. But leave a thumbs up. Okay. I will make a trade-off with y'all. Leave a thumbs up on right now. Go to the YouTube. Leave a thumbs up on this video if you guys want me to do that. I don't even know how many. We probably have a shit amount of thumbs up because I'm so bad at promoting myself. How many thumbs up do we have right now? I'm going to put you all on blast. What? 337? We had like 10,000 people watch this shit today. Fuck that. You guys need to push this up to at least 500. What? That's crazy. We had like 10,000 people watching. No, don't thumbs up in the chat, Vanya. Thumbs up on the video. Jesus. Okay, if you guys do that, if we get to, I don't know, 600 thumbs up, I'll start doing more trading videos. Like, I'll just literally leave the music on so that you guys have nice background. And I'll just sit there and trade all day. Because I'll be honest with you, a lot of people think day trading is super active. It isn't. It isn't. And anybody that tells you it is or shows you that it is, they're fucking fronting. That's not how it is. Like, literally, day trading is like fishing, where you can sit there all day on your boat wearing a ridiculous outfit. You know, you're casting your lines for hours, and then you might get a sea bass, you know, the size of your thumb, right? Like, literally, day trading is like that. It's not glamorous. It's not like you're sitting there all fucking day clicking around and just rolling in the dough. Some days you have these huge trades. where you're like, holy shit, I made $6,000-$7,000 today. Some days you're making $300, some days you're losing $1,000, right? But the point I'm trying to get at is it's not a very active thing. Like, I will be providing commentary as to what I'm looking at. But it's not like you're just actively continuously taking trades. A lot of it is just fishing. You're just waiting for the perfect setup. Like this one that I showed you here. This was the perfect fucking short here. Like, even if you didn't play this breakout, this right here was the perfect fucking short. Like, that's as optimal a trade as you're going to get, honestly. And that might be your only trade. That might be your only trade. Rob Sipe donated $5 to St. Jude's. Thank you so much, good man. Thank you so much, brother. I appreciate you. Nigel is on one. I'm going to put this user in timeout. I felt bad when Z was just trying to close his position to focus on the video. Yeah, bro. I mean, I like that we're getting a lot of donations today for St. Jude's, so I guess that's a silver lining. But yeah, where do you get your music? Copyright free? I mean, because I can't live stream with listening to Biggie and shit. Like, I would just have to type in copyright music in YouTube, and there's those YouTube channels that are running streams all day of music, copyright free music. Best live stream on FOMC. Thank you, Suresh. Thank you so much. I would say have some commentary. Yeah, I'm gonna have some commentary, but a lot of it is just gonna be me concentrating. I'm up 7K. Thanks for showing the charts. Hamza, that doesn't make me feel better. You're up 7K and I made $500. Nah, man, that's good. At least one of us profited. As long as somebody, at least one person profited, then I'm happy. I'm happy. But yeah, okay, cool. You guys got this up to 584. I need more likes. But I will do it. All right. Let's see. Do you guys have any questions? The market is about to close in 20 minutes. Love you, Z. Appreciate you, Natalie. Love you too. Do you guys have any other questions or things you want me to address? Says 1102 watching. Yeah, 1102 watching currently, but I think we had 8,000 views so far total, right? You got 7K donated. Yeah, appreciate you guys. Thank you guys so much. 6.8K donated in exactly. So thank you guys so much. Are you just trading futures? Okay, so right now, yeah, I mean, you could trade options, you could trade futures, but the reason that I'm trading futures is because I don't have time to, like, when I'm doing a live stream, I'd much rather trade something that is that has straightforward pricing. So when you're looking at a futures contract, right, it's not like options. So options pricing is more complex. Options, as you know, are based on a lot of things such as implied volatility and theta. There are so many more complex elements that go into an options pricing, whereas a future trades kind of just like a stock. It's face value pricing. So if I short at 38.50 and I ride it down to 38.40, well, that's a 10-point move, right? Whereas if I short an option at 38.50, if I buy a put option at 38.50, it comes down to 38.40 and then it just like hangs out for a little bit. The option will lose money because an option's price depends on the activity of that option. So you need people to continuously be bidding up the demand for that option for you to make money. The minute that you see price action stagnate, that's why you tend to see options values drop, even when there's just flat pricing, right? The option, the underlying has to continue making big moves and people have to continue buying into that option in order for that option value to go up. Whereas with futures, it's straightforward pricing. So if I shorted here, we went down and then stagnated for a bit, the futures contract is not going to lose value because it's literally based on the exact price, the face value price, right? So it is a lot easier when you are trading volatility and you don't want to monitor the options pricing itself, and you don't want to monitor implied volatility itself, etc. Now, if I was trading SPX options that were 0 DTE, meaning 0 days to expiration, ones that expired on November 2nd, yeah, the move is a lot larger than you would get on other instruments for sure, because 0 days to expiration they expire today. So if those go from out of the money quickly to in the money, then you're going to see a huge bump up in those options premiums, right? So hopefully that makes sense. Can an account of 25K trade futures? Yes, actually futures don't require, you don't have the pattern day trading rule with futures. That's one of the advantages. But you do need to have a margin account, and you do need to apply for futures trading. So you need to have two of those things. You can't trade futures on a cash account. You definitely need a margin account. Doesn't mean that you have to go into margin. It just means that your account has to be designated a margin account. Futures are the way forward. I mean, there's advantages, disadvantages. The one thing that I like about options is that, like, say I bought an SPX option, right? An SPX put option, 0 days to expiration. I bought it here. But let's say that the price went against me and Jerome Powell decided to flash everybody at the podium. And that was bullish for stocks, right? I can't lose more than I put into that option. I'll never lose more than the amount of the put option itself, right? Whereas if I shorted here and I didn't have a stop limit on futures and the price went up, well, I'm going to be down thousands of dollars, and the loss is endless until I either, close the position or get margin called. So there are advantages and disadvantages of both. I like both, but yeah. What's the difference in setups for a swing trade versus day trade? I rarely swing trade in this environment. I swing trade earnings. Like, we bought puts on Airbnb yesterday, which was a great call out by one of our analysts. But other than that, I'm not really buying positions for multi-days. So a swing trade, you're going to hold that for more than 1 day, whether it's 1 day, 5 days, 2 weeks, whatever. And that is a lot easier to do when the market is less volatile. Otherwise, you could just wake up and apply your day trading principles, and really go from there. There were 2 really optimal shorts today. One was the one that I took, and the other one would be, now this is hindsight, obviously, but the other one would be a short into this imbalance here, right? So once we created this imbalance and then we went up to retest that imbalance, you could have actually taken this right here. You could have taken that short as well. But it's a lot easier when you have sharpened your tool set, and we're day trading all day in the academy. That is one of the advantages of trading with a group, is that you get to see what everybody else is doing. You get to ask questions quickly. You get to have somebody check your mistakes. You get to have somebody confirm whether what you're doing is right away, right? That is the biggest advantage with trading in groups, especially groups that know what they're doing. And we don't take any, unless it's a YOLO. Like, if I'm like, I don't know whether AMD is going to crash or rally for earnings, so I'm just going to buy calls or buy puts. That's a clear gamble. And as long as you know that you're gambling, that's fine. But otherwise, I don't take low probability setups. I only dabble and goes for the other analysts as well, unless it's called out as a rare YOLO that we take for fun. In general, all of our trades are backed by high risk to reward ratios. Doesn't mean you're going to be right every time, but when you're wrong, you're minimizing your mistakes, and that's the goal, is to minimize your mistakes, right? and then maximize your profits. Clearly, maximizing my profits is something that I didn't do just a few minutes ago. For those of you joining, I closed the trade. It was for profit, but I closed it hella early. And then Hamza comes out and says, thanks, bro. I made 7K on that trade. I'm kidding. Shafiq, what's going on, brother? How you doing, bro? Thank you so much for always donating, man. Thank you so much. Appreciate you. Donated $20 to St. Jude's. Thank you so much. So why trade futures as opposed to stocks? You could buy inverse ETFs. Inverse ETFs are very shit. A risk for reverse splits all the time. A risk that they go to zero. They're terrible holds. Futures give you much more leverage. They are tax advantaged. Only 60% of a futures trade is considered long-term capital gains. I mean, short-term capital gains. 40% is considered long-term capital gains. Even if you're day trading the future, get that. So the futures contract that I just day traded today, 40% of that is going to be considered long-term capital gains. Go figure. I'm not going to argue with that rule, but go figure. No pattern day trading rule. They trade 23/6, 23 hours a day, 6 days a week. So virtually open all day. Price action is a lot more predictable than inverse ETFs, which look like heart rate monitors. They look like shit. And if you only stick to a few tickers, like the indices, for instance, you only really need to day trade S&P futures. You can also dabble in NASDAQ futures. I dabble in oil futures. And sometimes I dabble in treasury futures as well. But yeah, there's a lot of advantages for futures trading, and they're extremely liquid. If you could only DCA into one value stock at these prices, which would it be? Only one, Z. Shalita, why are you trying to pin me down? Okay, one value stock, this is very easy. SPY-V. There you go. SPY-V is the value ETF of the S&P 500, and it also pays a dividend. I wouldn't start DCAing now, but certainly on the next support level, SPY-V is the one to hold if you just want one value stock. Okay. So if you lose connection and can't sell your futures, you're screwed. Bro, I mean, that goes for everything, right? That goes for everything. I don't know. I don't know what you mean. If you're at a hospital and you're hooked up to a life machine that requires Wi-Fi, or you're hooked up to a life machine that requires power, and the hospital loses power, you're screwed. I mean, that's not really a fucking revelation, bro. Unless, you can set up a stop limit, beforehand. And even if your connection goes out, the stop limit will be hit because it's on the order books of the platform, right? You can't set up a stop limit or a fail-safe if you're at a hospital and you're connected to a machine that's saving your life and the machine goes out. Have you ever been in a real fight? Oh my God. Of course, a lot. Not happy about that. Not happy about that. But now we reserve it for the boxing ring. Why are you asking that? Dalgend Reviews. Why are you asking that? What platform do you use to trade futures? Sean asks. TOS. Thinkorswim. Do they ever skip over your stop in futures? No, unless you get gapped up or down during the 1 hour that the futures close. The good thing is that even when trading while distracted, you came away green. Yeah, for sure. Appreciate you. Thanks for going live, man. Appreciate you, Lewis. All right. Is trading your full job? Yes, it is. Z always ready to fight someone. No, I'm not. I'm not, but the motherfucker said he was going to strangle me. What you want me to say? Just sit here and take it with my pants down? If somebody says they're going to strangle me, then, I got to ask how much they weigh. See if it's a fair fight. He said he weighed 215. Didn't sound like he had boxing experience. I'm 175. Sounds like a fair fight. Have you ever been to Madrid? Yeah. DB Cooper asked. That's a nice name. I know the whole story of DB Cooper. Do you think he's still alive, by the way? For those of you that don't know who DB Cooper is, one of the most fascinating stories you'll ever hear. Super fascinating. This is like some shit that... Did they ever make a movie on DB Cooper? I don't know. But he's like one of the only people that ever hijacked an actual passenger aircraft. Got away with it, and nobody knows where he is. Which is crazy. I don't know if he's alive. Because he disappeared, I think it was in the 70s. So, who knows? All right. DB Cooper Netflix documentary? Yeah, but I want them to make a movie on it. I'll check that out. Oh, you know what? Actually, I think I saw that Netflix one. That's a few years old, right? I'll check it out. I think I saw that one, but I want them to make a movie like with fucking Leonardo DiCaprio or something. That'd be dope. All right, guys. Cool. All right, guys. Thank you guys so much for joining. I appreciate each and every one of you. If you haven't already, hit that thumbs up on your way out, please. Always enjoy doing these. We'll be doing more live streams in the future, but I love each and every one of you. Thank you guys so much, and I will talk to you in the next one. Stay safe out there, traders. Peace.